me and my wife, we want to move to the Gold Coast.
Could be cheap properties after this cyclone.
Absolutely. We don't want to buy it in a trust or a business having a owner occ. You know what I mean? Because we don't want to damage our borrowing capacity.
Yeah, so you essentially want to buy it as an investment property and then rent it off yourselves, in short.
Yeah, and then because we're going to be bouncing around, I was doing renos and different stuff. We'll Airbnb it for 2 months while we go to Newey and do a reno in Newey and then head back. And
good accountant will help you with this, but if you buy it in a corporate entity and then lease it off that corporate entity, then it's not your owner-occupier property. You're not getting any of the owner-occupier benefits. You're not going to get your capital gains tax exemption. So it's essentially acting exactly as an investment property would act. I mean, get some advice around it, obviously, from an accountant, but generally what people try and scheme the system in a way where they want to get the capital gains tax exemption and they want to rent it off themselves and get the probably not on, but if you're genuinely going to have it as an investment property in a corporate entity, protect your borrowing capacity, as it's going to be an investment property of which you may live in or go and visit when you're there, you can't perceive that as being an issue.
We've just created a positively geared trust. There's a fair bit of equity in it. The income, it's only just positively geared. Is there a way I can pull equity out of that without having to pay the interest through that trust? Like, can I lend the equity to another trust or something?
It depends on how good your accountant is. That's where this strategy either is really good for certain people and not so good for other people. It all comes down to how your accountant accounts for the numbers and then obviously how confident they are of then writing that letter of which you give to the bank.
Yeah. If I pull 200K out of it, that's
going to be negative again, right?
So you can't really... I mean, there must be a way around it, I hope.
Well, you can. You just need a good accountant. So he needs to write the letter before you pull the equity out of it, right? Like that's the thing.